Hey, I'm Rahul, founder of Aris Alpha. Here I break down the US finance and investment market so you can make smarter money moves. Let's get into today's topic.
Have you ever wondered why so many people invest in index funds and ETFs instead of picking individual stocks? The truth is, these simple tools have created more millionaires than most hot stock tips ever could. And the best part? You don't need to be an expert to start. Here's the problem. Most new investors think investing means finding the next Tesla or Amazon. They put all their money into one or two stocks and then panic when the price drops. That is not a strategy. That is gambling. The good news is you don't need to guess winners and losers to build wealth. Index funds and ETFs give you a smarter, safer way to grow your money.
Step 1. What are index funds and ETFs?
An index fund is simply a basket of stocks that tracks a market index, like the S&P 500. Instead of buying one company, you're buying tiny pieces of hundreds of the biggest companies in America. An ETF, or exchange-traded fund, works the same way, but trades like a stock during the day. Think of them as diversified bundles that give you instant exposure to the market without the stress of stock picking.
Step 2. Why they work.
Here's why they're so powerful. Over the long term, most active investors fail to beat the market. Research shows that 80 to 90% of mutual fund managers underperform the S&P 500. Index funds and ETFs solve that problem by matching the market instead of trying to outsmart it. That means steady, reliable growth year after year.
Step 3. Costs and fees.
Costs and fees are one of the hidden killers in investing. Mutual funds often charge 1% or more every year in management fees. That doesn't sound like much, but over decades, it can cost you hundreds of thousands of dollars in lost growth. Index funds and ETFs usually have fees as low as 0.03 to 0.10%. That means more of your money stays invested and compounds.
Step 4. How to use them in real life.
Here's how you can apply this right now. Start with a core fund like an S&P 500 ETF or a total market index fund. These give you broad exposure to the US economy. If you want to add growth, you can layer on sector ETFs like technology, healthcare, or green energy. And if you want stability, you can add a bond ETF to balance things out. The key is consistency. Invest regularly, no matter what the market is doing. That's called dollar cost averaging, and it smooths out the ups and downs over time.
Step 5. Real numbers example.
Let's put it into perspective. If you invest $500 a month into a simple S&P 500 index fund, and the market grows at an average of 8% a year, in 30 years, you'll have over $680,000. That's the power of compounding, and you didn't have to pick a single stock. So here's the bottom line. Index funds and ETFs are simple, low-cost, and powerful. They let you grow your wealth without stress, without guessing, and without paying high fees. If you're serious about building long-term wealth, they should be at the core of your portfolio.
That's it for today's discussion. Apply these insights, share them, and let's keep building a smarter money culture together.